Welcome back to Investing Talk Podcast.
Today we're looking at energy fuels.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. When you look at energy fuels, you're really looking at one of the most maybe contradictory stocks out there right now.
Contradictory how?
Well, the central story is this, high risk, high reward pivot. They're trying to transform from a, let's say, traditional cyclical uranium miner into something much bigger, a diversified, strategic U.S. critical minerals powerhouse.
And wow, the market is absolutely eating up that story, isn't it? Even if the financials maybe aren't quite there yet.
Exactly.
We almost have to start with just the momentum this year. Energy fuel shares are up, over 215% year to date?
That's right.
I mean, that is massive outperformance. It's crushing its sector peers, leaving the S&P 500 completely in the dust. The enthusiasm is just off the charts.
It is. It really is. But, it's an enthusiasm based almost purely on future promise.
Yeah.
If you actually look at the technical signals, they're completely mixed. It reflects this tension.
Okay.
So while the overall trend is, strongly bullish, suggesting momentum, the core fundamental ratios, things like the price-to-earnings ratio, well, some analysts still rate those as sell.
So for listeners who maybe don't track these metrics every single day, what does a sell rating on PE really tell us here in this kind of situation?
It tells you the market is valuing ambition, right? Not current profitability. A company with a high PE, or like in this case, a negative PE, because they're actually losing money.
Right.
It means the stock price is baking in this huge surge in future earnings that, well, it just hasn't happened yet. We even saw, a little dip, 1.14% drop on September 29th, 2025. That kind of short-term volatility is pretty standard when investors are sort of wrestling between massive growth hopes and these persistent quarterly losses.
Okay, but that growth expectation, it's tightly linked to this strategic pivot, right? Moving beyond just uranium.
Yes.
The biggest news driving that excitement, I think, was back in September 2025. The stock surged over 9%.
Yeah, just over 9.5%.
Following that announced collaboration with Vulcan Elements, and this isn't just like a normal business deal, it feels more like a national strategy, building a resilient U.S.-based supply chain for rare earth magnets.
Exactly. They are fundamentally shifting their business model.
Yeah.
And that's where they're digging that competitive moat, you could say.
Right.
They're not just one thing anymore. They're the largest U.S. producer of uranium, and they're a first mover in U.S.-based rare earth processing.
Okay, so why is that combination, that model, so powerful and, I guess, so hard for a competitor to copy?
It's the vertical integration.
Yeah.
It really is. They have the feed material, the monazite sands, often coming from their existing heavy mineral sands operations.
Oh.
And they have the infrastructure, the White Mesa Mill, to process it right here in the U.S. So that covers mining, separation, and soon actually producing the most critical elements. That capability, spanning two totally different but equally strategic commodities, that makes them exceptionally difficult to compete against.
And they're really swinging for the fences here, aren't they?
Flawed.
Focusing on the toughest materials in that whole supply chain.
Absolutely.
We saw that innovation recently with their pilot production of heavy rare earth elements, the HREs. They actually produced, 29 kilograms of dysprosium oxide?
That's right, 29 kilos.
Yeah.
And they've got plans for terbium production, too.
And this is a really critical distinction, isn't it? Listeners should probably understand why these HREs, these heavy rare earths, are so vital.
Yeah. Definitely. These are the elements you absolutely need for extremely powerful, high-temperature magnets.
Okay.
We're talking the kind essential for things like missile guidance systems, advanced fighter jets, and also the specialized motors in high-end EVs.
Right, the really critical stuff.
Exactly. And currently, the U.S. is almost entirely dependent on outside sources, mainly China, for these specific elements. So Energy Fuels is actively trying to fill a really critical, almost defense-related supply gap.
But innovation that difficult, I mean, especially building complex separation facilities pretty much from scratch, that can't be cheap.
No way.
Which is why, I guess, when we look at their Q3 2025 financials reported early November, we see them kind of bleeding cash right now.
Precisely. Let's just look at that contrast. On the revenue side, great news. Total revenues surged nearly 340% year over year.
Wow.
It's $17.7 million. mostly thanks to some well-timed uranium sales. Their trailing 12 months revenue is now, a pretty respectable $78.74 million.
Okay, so top line looks good. Yet they posted a net loss of $16.7 million. That's 0.7 per share.
Yep.
That's why that PE ratio flags a warning, right?
Right.
So how can they justify spending so aggressively?
It's totally strategic. It's intentional. The reason for the loss needs context. Their exploration, development, and processing expenses jumped, wait for it, 244% year over year.
244%.
Yeah. They are aggressively pouring capital into developing new uranium sites like the La Salle complex and the Pinyon Plain mine.
Okay.
And at the same time, they're spending big on the rare earth separation facilities. They are basically sacrificing short-term accounting profits to build massive long-term capacity and grab market share in these critical minerals.
So management is basically telling investors, look, this financial pain is just the cost of building this thing right now.
Pretty much.
And that these operational improvements, they expect them to lead to, quote, significant cash margins and better gross margins starting in 2026. They're asking for patience during this build-out phase.
And they can afford to ask for that patience. Why? Because their balance sheet is exceptionally strong. They ended Q3 with excellent liquidity, nearly $300 million in working capital.
Okay.
Zero debt, and almost $100 million just sitting in cash. That is, a fortress balance sheet.
But their financial power got, turbocharged recently, didn't it, with that massive capital raise? We should probably analyze that. The $700 million convertible senior notes offering due in 2031.
Yeah, that was huge. That influx of cash brought their working capital close to $1 billion.
$1 billion.
Yeah. I mean, just put that in perspective. That gives them the financial firepower to basically ignore short-term commodity price swings and just focus entirely on the long game.
Okay, but whenever a company issues convertibles, the immediate question from investors is always dilution, right?
Always.
Is this going to flood the market with new shares and tank the stock price?
Right, and that's where Energy Fuels pulled off a bit of a masterclass in financial engineering, really. They use something called capped call transactions alongside the note offering.
Okay, capped calls. For the average investor, what does that technical stuff actually mean for the share price?
It means the company basically bought a financial hedge to protect current shareholders. They effectively boosted the conversion price for those notes way up to $30.70 per share.
$30.70.
Yeah, it's a massive cushion. The stock would essentially have to nearly double from where it's been trading recently for those notes to even start converting into common shares.
Wow.
It's a really smart way to raise a ton of capital without putting immediate downward pressure on the current stock price.
That's a crucial detail then. So they get the capital without the immediate dilution risk. That gives them maximum flexibility. Okay, so let's look ahead now, because the next 3 to 6 months feel absolutely critical for proving the strategy works.
They really are. And the analyst consensus kind of tells that story. The expectation is definitely for a loss in 2025 overall. The consensus estimate is around $98.33 per share.
Okay, still red ink this year.
Right. But the forecast flips dramatically in 2026. They're projecting a return to profitability, maybe 0.07 cents per share. And that would actually be the company's first annual profit since it listed on the New York Stock Exchange. That'd be a huge inflection point.
Monumental, yeah. That shift in guidance from red to black, that must be why the overall analyst rating is a strong buy.
Exactly. With a consensus 12-month price target around $16. And some really bullish targets stretching up near $21.50.
Yeah, $21.44 is the high end I've seen. The market is clearly pricing in that 2026 profit potential and the whole strategic transition.
So what are the key short-term movers we should be watching over, say, the next 90 days?
Well, the primary catalyst is operational, I'd say.
That heavy rare earth launch you mentioned?
So, management is targeting initial production of terbium oxide near the end of this year. If they actually execute on that, that truly is a market-moving event because it would mark the first commercial quantity of these critical HREs produced in U.S. history. It basically validates the entire diversification strategy in one go.
Huge validation. Yeah. Okay, what else beyond the operational news?
Well, there are some market structure things to watch. You might see some institutional buying around mid-November as funds adjust their year-end positions, maybe adding exposure to critical minerals.
And then December always brings that potential volatility from ETF rebalancing. That could move the stock quite a bit, especially given its massive run-up this year.
Right, gets included or weighted higher in ETFs. And we can't forget the speculative stuff, the rumors.
Never.
In the uranium world, there's always that background chatter about potential long-term supply contracts with big U.S. utilities, right? Especially with the policy push for nuclear energy security.
Definitely a possibility. And on the rare earth side, the rumors persist about potentially substantial offtake agreements. Could be defense contractors who desperately need reliable, non-China sources of dysprosium and terbium, or maybe major EV manufacturers looking to secure their magnet supply chains. If either of those kinds of rumors turn into actual concrete agreements, that would likely rocket the stock and seriously de-risk the whole strategic pivot in investors' minds.
Okay, let's zoom back out just quickly to the technical picture. The stock's been consolidating lately, right? Near $15.65.
Yeah, trading in a bit of a range, you see pretty firm technical support down around $14.
Okay.
And resistance seems to be sitting around the 50-day moving average, which is about $17.12 less right now. But the overall bias, technically, still looks highly bullish.
And that massive gap between the recent 50-day average and the 200-day average, which is way down near, what, $8.70?
Yeah, it's a huge gap.
That shows the market really believes the long-term trend is locked in, doesn't it? Regardless of any short-term wobbles.
I think that's a fair interpretation, yes. It suggests strong underlying conviction.
So let's wrap up with Whisk. We have this amazing growth story underpinned by strong financing now, but they're still losing money quarter after quarter.
Right. The primary risks are still inherent commodity price volatility, especially uranium prices. They can swing wildly.
Sure.
But probably the biggest risk right now is project execution. Can they actually build and ramp up this really complex rare earth separation business on time and on budget? That's the key question.
And geopolitics, I suppose.
Always a factor. Geopolitical swings still affect both markets, uranium and rare earths. But the resilience, I think, comes from their multi-commodity strategy.
Yeah.
Having uranium, rare earths, and those heavy minerals provides a crucial sort of shield if there's a downturn in just one sector.
Okay, so that diversification helps manage risk. So it sounds like Energy Fuels is suitable for maybe two types of investors. Short-term traders playing these next few months of catalysts.
Yeah, potentially.
And also long-term investors who are betting on the scale, the innovation, and these, massive U.S. policy tailwinds pushing for domestic critical mineral supply.
I think that's the key takeaway. Despite those ongoing net losses, that pivot towards critical national assets, combined with that almost $1 billion capital cushion,
Yeah.
it really suggests Energy Fuels is transitioning away from being just a cyclical mining company.
To become what?
Fundamentally, maybe a strategic national asset.
Which really raises a final provocative thought for you listening. Is Energy Fuels truly an energy company anymore? Or has it fundamentally become more of a defense and national security stock? And how does that change the way you might value it going forward?